Welcome back to Investing Talk Podcast. Today we are taking a focused look at the conversational AI leader, SoundHound AI. And we're tackling that big question so many of you have asked. Is now actually a good time to buy this stock? Before we jump into the numbers, just a quick reminder, please subscribe, like the show, and leave a comment below. Also, if you want us to look into a specific company, definitely leave us a comment right after this intro. Let us know. Okay, so let's unpack this. SoundHound AI. It's a fascinating situation, really. They're a major player in voice recognition, but that stock, wow, it's seen some incredible volatility. We've looked at several sources covering their financials, the competitive scene, and importantly, what's coming up for them. Our goal here is to give you the clearest possible picture of the risk versus the reward.
Yeah, and what's really interesting here is that we're looking at a pure growth play. It's all about the future potential. When you analyze a company like SoundHound AI, the core tension is always that rapid growth potential versus the current financial reality, valuation right now. It really hinges heavily on the promise of future profits, maybe not so much what's on the balance sheet today.
Right. And when you look at those promises, I mean, they are certainly impressive. The revenue projections, analysts are pretty bullish, aren't they?
Oh, definitely. They estimate revenue could nearly double in 2025 alone.
You have to bull, that's huge.
Yeah. And then if you look further out, say, to 2026, projections hit around $214 million. That's still showing like a 29% growth rate. So it signals really strong, resilient demand for their kind of conversational AI.
Okay, strong demand, big growth.
It does, but we probably need to pump the brakes just a little bit there, because while that projected growth is, the heart of the bull case, it's currently being funded by burning through quite a bit of cash. We are seeing mounting losses, which, okay, that's pretty common for tech companies scaling up, but also their profit margins, specifically the non-GAAP ones, are sitting around 50.8%.
Okay. Could you maybe clarify that number for us? Because, 50% sounds pretty good on the surface. Why is that a caution flag if they're losing money overall?
That's a really great question, actually, because it kind of reveals their whole strategy right now. See, non-GAAP gross margin, that's basically what they earn on the product before you factor in all those massive operating expenses. Think sales, R&D, admin costs.
Okay.
So that 50.8% margin tells us the underlying tech itself is solid, it's profitable on a, let's say, unit-by-unit basis. But the reason they're losing money overall is that they are spending aggressively to grab market share.
Right, investing in growth.
Exactly. Hiring sales teams, pushing into new markets, pouring money into R&D. They're actively choosing scale today over optimizing for profit in the short term.
That makes a lot more sense. So if this high valuation is really banking on them conquering tomorrow's market, we have to ask, how strong is their competitive position right now to justify burning through cash like that?
Yeah, and connecting that to the bigger picture, their positioning is absolutely critical. SoundHound AI is playing in this huge voice recognition market, right? It's projected to hit something like $50 billion by 2030. Massive.
$50 billion. Wow.
But they aren't trying to grab all of it. They seem focused on specific high-value niches where their tech gives them a real edge.
Okay, so that's where it gets really interesting then. What actually gives them a fighting chance, especially in such a massive space with giants like, Google and Amazon playing too?
Well, their main advantage seems to lie in their specialized proprietary tech. It focuses on something called low latency processing.
Low latency, meaning faster response times.
Exactly. Latency is just the delay between you speaking a command and getting the response. Their tech minimizes that delay, allowing for almost instant responsiveness. And that positions them perfectly for deals in, let's say, high-speed or high-stakes environments.
Okay, like what specifically?
We're talking mainly about the automotive sector and the quick-service restaurant market, QSRs.
Fast food drive-thros and such.
Precisely. In a QSR setting, the speed of that voice ordering directly impacts how many cars they can get through. Customer satisfaction, it's crucial. And similarly, in a car, you want an immediate response. It's not just convenience, it's a safety feature. That's where their tech really shines.
And we've actually seen that advantage translate into some concrete wins, haven't we? They've been actively expanding, sometimes through smart acquisitions, it seems. Like they recently finished integrating SYNQ3. For anyone not familiar, SYNQ3 was pretty specialized in voice automation for restaurants, right?
Yeah, exactly right. SYNQ3 was focused squarely on that QSR space. And that acquisition, well, it didn't just strengthen their market reach, it immediately added about $6 million in annual recurring revenue.
Okay, so real revenue, not just tech.
Yeah, they bought existing customer relationships, installed systems. It wasn't just about the tech. And we're also seeing them expand partnerships, like embedding their solutions into hotel booking platforms and service management systems. They're sort of moving from just being a tech provider to becoming, well, embedded infrastructure.
That transition really brings us to momentum, doesn't it? The last quarter especially showed some significant operational movement. SoundHound AI reported Q2 2024 earnings that, well, they significantly beat what analysts were expecting.
Yeah, revenue grew 54% year over year, came in at $13.5 million.
And management actually raised their full-year guidance because of that, which usually signals some real confidence.
It does. It suggests the underlying business is performing well.
Okay, but let me just inject a bit of skepticism here for a moment. We're talking about great revenue growth, these strong contracts, huge market potential. Sounds fantastic. But if the story is that compelling, why did NVIDIA sell off its stake in the company earlier this year? That definitely made some headlines and seemed to worry investors.
That is a really critical point, and it definitely needs context. The NVIDIA sale, well, it was likely more of a financial move by their venture capital arm, maybe portfolio rebalancing, maybe taking profits. It probably wasn't a definitive vote of no confidence in SoundHound AI's actual technology.
But it still caused ripples, right?
Oh, absolutely. You're right. It did raise eyebrows. It increased market uncertainty and probably contributed to some of that volatility we mentioned earlier. You kind of have to view it as a factor influencing the short-term stock movement, the technicals, but maybe not the long-term fundamental story.
Okay, fair enough.
And looking purely at those fundamentals, they do have real partnership traction building. Key wins include that multi-year contract with a top 10 global automotive OEM, one of the giant car manufacturers for Europe and Asia.
That's significant.
Very. And in the QSR space, they're reporting customer retention rates over 95%, which is quite strong. Plus, they're expanding the use of their Employee Assist product across major restaurant brands. So momentum is there.
And these wins, they really set the stage for a couple of specific critical short-term events, don't they? Events that could really act as inflection points for investor confidence just in the next few months. These are dates you probably want to circle on your calendar?
Absolutely. First up is the Q3 2024 earnings report that's scheduled for November 15th, 2024. Investors will be watching that one intensely. Can the company keep up that revenue acceleration? And crucially, can they show improving gross margins?
Right. Proof the expansion is efficient.
Exactly. That's the first big test. Then second, you've got the Q4 and full year 2024 earnings, likely in late February 2025. That'll give us the first complete picture for the year since their big strategy shift and that SYN Q3 integration.
Okay, so those are the confirmed events. But beyond that, there's also quite a bit of industry buzz, isn't there? Speculation.
Yeah.
And when we're talking about a stock that seems priced for future perfection, we kind of need to address those what-if scenarios that could potentially push it even higher.
Definitely. Market chatter, for instance, suggests a top 5 U.S. QSR chain like a household name might announce a nationwide rollout of SoundHound's voice ordering tech.
Nationwide. How big are we talking?
The number floating around is 3,000 plus locations. If that happens, well, that would be massive validation for them.
Wow. Yeah, that would be huge.
And that potential QSR deal is big because it proves their tech can scale outside of just cars. But what's maybe equally important, though less talked about, are the rumors about deeper structural integration. Specifically, there's speculation about a strategic partnership with a hyperscale cloud provider, like an Amazon AWS or Google Cloud.
Exactly. A deal like that could dramatically cut their hosting costs and really speed up their distribution, make deployment much easier.
Okay, that makes sense.
And furthermore, connecting back to that high-margin automotive business, there are reportedly negotiations underway with one of the world's 3 largest automakers for a really comprehensive global deployment starting in the 2026 model year vehicles.
So potentially massive deals on the horizon.
These rumors definitely highlight the substantial upside if, and it's a big if their execution holds up against these very high expectations.
Okay, so given all this excitement, all this pressure on future performance, let's switch gears slightly and look at the technical picture. Because like we keep saying, the stock itself has been incredibly volatile.
Yeah, the technical view is, let's say, mixed right now. While the average analyst rating is technically a buy, which shows strong belief in the fundamentals, the consensus 12-month price target actually suggests a potential decrease from its recent price, which was around $18.74. Wait, a decrease? So analysts are saying buy, but think the price might drop. How does that work?
It implies they believe in the long-term story, but think the market might have priced in a bit too much speculation too quickly in the short term, maybe gotten ahead of itself.
Okay, so near-term caution despite long-term optimism.
Kind of. And the broader market sentiment seems to confirm that nervousness.
You mentioned the fear factor.
Right, the fear and greed index. It's currently indicating a level of fear surrounding the stock, and that anxiety is often what fuels high volatility like we're seeing. Near-term predictions suggest the stock could bounce around between, say, $17.26 and maybe $22.57. It reflects that tug of war between the hype and the current financial reality.
Got it. So volatility is expected.
Definitely. And when we try to summarize the key risks here, we kind of circle back to those fundamentals and that core growth stock idea, the main risks. They really remain that high valuation you are absolutely paying today for success that hasn't fully materialized yet.
Right, paying for the future.
And the ongoing high cash consumption and losses. They need that growth to happen reasonably soon to justify the burn rate. Also, for any company in a high-growth field like AI, a prolonged tough market could make it harder to raise more capital down the line if they don't reach profitability relatively soon. Sector risk is always there, too.
Okay, so we've laid out the rapid growth forecasts, the unique competitive niche they have, the low latency in QSR and automotive. We've talked about recent operational wins, the noise around the NVIDIA sale, and these really critical upcoming catalysts. So bringing it all together. What's the synthesis? Based on all the sources we looked at, what's the final verdict on that core question? Is it a good time to buy now?
Yeah, synthesizing all that data, the sources collectively give SoundHound AI an overall bullish rating. It comes out to about a 7 out of 10.
7 out of 10. So
Yeah.
bullish, but not a slam dunk.
Exactly. It's certainly a high-risk scenario, no doubt about it, but the potential upside is seen as highly compelling, which justifies that relatively high rating.
And what's driving that bullishness mainly?
It's primarily driven by a few key things. First, the strong structural tailwinds for the AI sector in general. Second, that resilient demand we talked about for conversational AI in those high-value sectors like automotive and QSR. And third, those critical upcoming catalysts we mentioned, specifically the next 2 earnings reports. Those events really provide clear pathways for near-term momentum. They could either validate the current high valuation or, well, deflate it somewhat.
So based on that, the sources seem to suggest this stock might be attractive for 2 different kinds of investors.
That's right. On one hand, it could be suitable for short-term trading opportunities purely because of that high volatility. Sharp swings on news or rumors are likely. And on the other hand, it also presents as a compelling long-term investment if you believe in the structural growth story of AI and SoundHound's place in it.
But the key qualifier there is,
You absolutely must be an investor who can tolerate significant volatility, big swings up and down, and you need to be able to really focus on that longer-term, multi-year sector trajectory, not just the day-to-day noise.
makes sense. Tolerance for risk is key.
Absolutely. And maybe as a final provocative thought for you, the listener, to mull over, given how heavily the current valuation relies on future success, especially in the automotive sector and those big potential restaurant rollouts, the key question you should really be wrestling with is not if the technology works. It seems like it does.
Okay.
The real question is whether the company can successfully demonstrate operating leverage from those potentially high-margin contracts in the next couple of earnings reports.
Operating leverage, meaning turning rising sales into even faster rising profits.
Exactly. Can they show that as revenue grows, profits grow even faster because the costs don't scale up proportionally? That demonstration translating top-line revenue growth into bottom-line margin improvement, that will likely be the deciding factor. It's what separates a justified high valuation from just, well, a high valuation based on hope.
That's an excellent point to end on, showing the leverage. Okay, we've covered the financial hurdles, that unique market niche, and the really crucial upcoming catalysts for SoundHound AI. We really hope this analysis helps you stay well-informed as you consider your options. Thank you for joining us for this analysis.